Yes, I think I'm live. Let's check YouTube. Let's make sure the audio is good. Guess I'm okay. So hi everyone. Let's just type something. Um, I mean, no one is watching right now, but maybe someone will join. And if someone joins, so I will be checking like every now and then to see if we have anyone looking on this live stream. If you didn't see, by the way, yesterday I made a live stream about Finviz, the website Finviz, where I kind of went tab after tab and explained what are my favorite features over there. And every now and then I talked about investments that I actually made. One in Ulta and the other one was in Build-A-Bear. These are investments I made in the past, not investments that I made recently. I said that I bought Build-A-Bear again, but I actually spoke about Ulta more, and I explained why I bought Ulta back then. So I'm just going through random stuff. Honestly, I'm not. There's no agenda again today for what I'm gonna talk about. I've been looking at Levi Strauss Company for a while now. This is the Wall Street Journal, by the way. Highly recommended. Every morning I read the Wall Street Journal. It's a good source of information if you want to get some overview about the markets. It's a good way to start your day. And over here I'm just looking at the financials of Levi Strauss. Okay, it's a very stable company, by the way. It's a company where the revenues are stable for a while now. They do not grow in a an extreme fashion, but they also do not decline in a way where you're gonna lose, let's say, 10-15% suddenly of your stock price because they announced that the revenues declined by, I don't know, 30%, for example. They're not a growth company, just put it that way. So I love looking at the Wall Street Journal. I love looking at Yahoo Finance too. When I make my DCF, which I try to make it very simple, by the way. I don't go into complicated DCFs and complicated models. Although I can, it's not that you can't do it. You can go and make complicated DCFs, but DCFs, for those who don't know, it's discounted cash flow model, where you try to predict the future cash flows of a company or a business, and then you discount it for today's value, and then you see whether the company you're buying is basically overvalued, fairly valued, or you know selling at a bargain. So yep. So over here in Yahoo Finance, you can go to analysis, and you can see the analyst's estimates. Okay, you can see the earnings, you can see the revenues, and you can actually see the history too, and you can see the earnings per share trend. So for the current year, analysts are expecting that Levi Strauss will bring in $6.41 billion for 2022. And for next year, they're expecting that they will bring 6.79 billion. That's the average, by the way. So if you want the low estimate is over here, which you can see it. It's 5.42 billion, while the high estimate is 6.95, which is almost $7 billion. The growth, as you can see over here, is not that high. For the current year is 11%, for the next year is 5.8%. So it's not a high growth company, but it is a boring company, and it's a company that's selling at a low PE. It's selling at a PE of 13.51 multiple, meaning that for every dollar of earning, you're paying $13.51 right now to buy this company. And the market cap is 7.72 billion. Target, according to analysts, is 25, which is higher than the current price, but it doesn't mean anything actually. The analyst can chase stocks. Whenever the stock is going higher, they will start increasing their target. Whenever the stock is going lower, they start lowering their targets. Sometimes they just chase the target to look that they're not missing by a big gap. So basically, Levi Strauss, what they do is they sell jeans. Let me show you. I started already writing about Levi Strauss, by the way. I started already writing about Levi Strauss. I can show you my overview that I did right now. So basically, when I research a company, I like looking at here. I don't know if you can see it. I think you can see it. Yep, you can see it, right? Yeah, you can. That's good. Awesome. So when I start researching a company, I like to look at the segments. I like to understand what the business is about, and the simpler for me, the better for me, honestly, and I think for everyone. The simpler the business model, the better for us. We don't want complicated company to start thinking how you're gonna guess, for example, what the future revenues will be, what the future earnings will be. And over here, when you look at Levi Strauss, they basically just sell clothes. They basically sell clothes. There's noise outside. I hope it's not bothering the live stream. Let me just. Give me a sec. Yep. So this is basically Levi's brand, Levi Strauss brand. So they have 5 main brands: Levi's, Signature by Levi Strauss & Co., Dockers, Denizen Brands, and Beyond Yoga, which they acquired in 2021. And the company makes splits actually the segments into 2, where they make Levi brands, which includes Levi's, Signature by Levi Strauss & Co., and Denizen Brands, and then they have the other brands, which is Dockers and Beyond Yoga. And over here you can see the revenue share of Levi's for 2021, and you can see that mainly the big portion, 87% of the revenue came from Levi's, and 8% came from Signature and Denizen. I don't know if I'm actually spelling it right, by the way. And selling it right, I mean. And then you have Beyond Yoga, which is only 5% of Levi's revenue. So basically, Levi is this one. This Levi company makes most of its money from Levi's brand. So basically, I'm just researching the company. I'm writing here the whole thesis for Levi. It's not complete yet, but what I do is I like to look for the 10K, and in the 10K, let me show you. In the 10K, you basically can see, I hope you can see it over here. Let me see if you can see. Oh yeah, it's really good. So in the 10K, this is not the 10K by the way, but I'll show you the 10K in a minute. This is the earnings results for the last quarter that ended in May 29th. Well, let me show you what I want to show you. So if you go to the 10K, the 10K is basically the annual report of a company. And the annual report, you can see almost everything you want to know about the business. Okay, and well, I have a lot of pictures, I don't like it, but whatever. Let me do it like this. Fit. So basically you have everything you want to know about the business. I'll show you, wait. Okay, so when we get here, you get to the business segment or the business part, and you can basically understand everything about the company. So they start by overview, talking about how they started in California, and you know, then you have the whole COVID thing that they talk about, then you have the segment. So I basically went through the 10K already. So they have, you know, they sell products in more than 110 countries. So if you think about it, you know, if you have a company, if you're looking at a company that's selling products in already 110 countries, then there's not a lot of space to expand, right? Like, how much can you expand your business? The only growth you're gonna get is probably by, you know, releasing a new product, or people just wanting to buy your product because they know it's good, and by increasing the price of the units that you sell. And if we take a look, I will show you in a minute, if you take a look at the last quarter in the US, they grew by 20%, and 10% came from basically higher higher price per unit, and the other 10% came from basically growth, people wanting to go and buying Levi's products. I'll show you. Revenue 20% on constant currency base. I think I have it over here. Yep. By the way, this is not like a last version. I still need to like rewrite things and change stuff, so it's just the beginning. So I was working on my DCF model, and as I said, it's a very simple one. It's not a complicated one. Where I try to figure out, or you know, estimate what revenues would be for the next 5 years, in this case until 2026, and then I try to see how much EBITDA they have as a margin of revenue. Okay, so basically I put here 13 because they already reached this mark, and they even reached higher, but when I do valuations, I like to stay, you know, as conservative as possible, especially if I'm gonna post this valuation, which I will at some point. I don't like to be very aggressive, because if people are gonna rely on my valuation, I don't want them to buy. Although I don't want anyone to rely on my valuation, because it's mainly made out of opinions. You know, just my opinion of what revenue would be and what might happen in the near future. So it doesn't mean much, because you can change as much as you want and as much as you like, and then you can get to any price you want to get to, by the way. Then I like to go to the capex, and then in the capex I like to change. First of all, I look at the actuals, how much the capex was, capital expenditure, how much capital expenditure was in 2019, 2020, 2021, and then I estimate how much it would be for the upcoming years. Again, it's simple. It's a simple valuation. You can complicate stuff more, but I just like keeping it simple, and that's basically it for the valuation. So if you want, we can just go through it right now. Let's go through it right now. So let's look at revenues for 2019, 2020, 2021. These what you see right here, by the way, these are this one is revenues from Disney. They made $67 billion in 2021. Yeah. Let's look at. Let's go here. You can go to any website and you can pull it from any website. So 2021. Let's see. 2021 was. $5.763 billion, and 2020 was $4.452 billion, and 2019 was $5.575 billion. Yep, capex. So I also wrote the formula. I copied and pasted the formula over here. So in case you guys want to know what it is, so you can just look it over here. So capital expenditure is basically the PP&E, which is property, plants, and equipment, plus current depreciation. The delta of property, plant, equipment plus current depreciation get you to the capex. I will show you how you actually do it. So just give me a second. Let's look. My shoulder is hurting me. I went to Lindt store yesterday. I got these. I don't know if you guys like chocolate. If you do, go to Lindt store, buy these chocolates. They're amazing. Sorry for the noise, I'm trying. By the way, the financial statement of a company, that's a very important thing for you to know if you're new to investing. The financial statement of a company is basically a snapshot. It's basically a snapshot of the assets and the liabilities of a company in a specific time. So, for example, if you go to the quarterly balance sheet, oh my god, what happened to my computer? No, it's loading. I have a slow computer, so I'm sorry for that. So it doesn't matter. For 2021, for example, okay, it shows you a specific uh, a specific timeline in the company's life. So basically, I want to show you the quarterly, balance sheet. It's more important for me right now. Yep, here we go. So it shows you the cash that the company had. It shows you also the liabilities of the company. It shows you the assets versus liabilities of the company, which how much money the company owes. Just give me a second. Mimi, what do you want? Come here. Come here. It's my dog. Come here. Want a snack? Come here. Come. Okay, just give me a second. Okay, get out. Here. Sorry for that. So where was I? Yeah. And it shows you the shareholders' equity, which is basically the net worth of the company. Okay, the common equity is the net worth. So let me show you. So the balance sheet is made out of three parts. It's basically three parts: the assets, the liabilities, and then the shareholders' equity. So let's look. Long-term debt, $1.9 billion. Cash, 600 million. Inventory is 1 billion. Inventory is increased by 10% from the last quarter. As you can see over here, they are 1,113, they were 1,006. All of the retailers that I'm looking at right now, all of the companies that sell clothes, that sell any products, they have their inventories levels are increasing, and I don't know if it's like a miscalculation by the management, but I also listened to the earnings call, and basically Levi said that they are preparing for increased demand, and that's why they're increasing their inventory. So I don't know if in Levi's case it's basically something that they actually did plan and it's gonna play out for like the better for them. But today I went to Levi's store and I saw that they have a lot of sales going on, like they're doing a lot of discounts, 50% or 40% or 30%, and you don't want that as a shareholder. If you see that the company that you're holding has a lot of markdowns, then the inventory that they hold, now it's going to be worth less than it was before, and also the income that they're going to bring, the net income they're going to bring in, or the revenues they're going to bring in are going to be less than they probably expected before, because they're doing these markdowns just to get rid of the inventory they have. But I mean like, you're selling jeans over here, you're not selling like something that, like, I don't think they just like random stuff, it's like jeans, and they can just like hold and last. Okay, net property, plant and equipment. This is the PPE that we talked about. Okay, 1,533,000,000 over here. Intangible assets are assets that are intangible. They're assets that you cannot like see, like not buildings, they're like trademarks, they're logos, stuff like this. Goodwill is basically when a company acquires a different company and they pay above book value. So when you have, like, let's say you're buying a company right now, okay, and you want to know, or you want to see how much you're going to buy it for, and you go to your, I don't know, to your lieutenant who operates these acquisition and mergers and whatever, and you ask him, okay, so how much should we buy this company? And then he goes and he tells you, listen, if we take the assets and we deduct the liabilities, we see that, for example, their net worth is $100. Okay, and of course you're not gonna buy them for $100 because you're paying also for the future potential of the company, right? You're paying for what the company might bring in for the future. So I say, okay, I'm gonna put a premium on this 100, and I'm gonna pay $120 for this business. So the $20 that you paid extra goes to the goodwill. This is the goodwill, basically. Let's see. Okay. So the PPE you get from the balance sheet, and the depreciation you get from the income statement, and you can also find it in the cash flow, by the way, the cash flows sheet. So you can find it over here. Wait, no. Yeah, well, over here they say cost of goods sold including depreciation and amortization, so you can find it over here, basically here. Depreciation and amortization, it's over here. Okay, so let's go back. So you can just do average of the capital expenditure. And go with the average. So basically it's 3% over here, and I can just go and do 3%, and I can get to the capex that I want to get to how much money they're gonna spend in the future. And by the way, when you do these calculations, you always have, you don't have to always, but I mean that's what I do. I go and I look at the guidance of the company, and I try to see if I'm aligned with their guidance. So in the earnings call, basically you'll see that the company, the CEO, the CFO, they talk about the guidance. They tell you, for example, the capex is expected to be, I don't know, $1 million for 2023, and then you see in our valuation the capex for 2023 is 203 million, so we are double what they're expecting to spend. So we need to adjust it to the company's expectations too, because they're the insiders and they know better than us how much money they're gonna spend in the future. That's a random example, by the way. It's not like what's happening with Levi. I'm just telling you a random example over here. Okay. And I basically write down everything in my own sheets too. I like to be very organized. I'm not organized in generally, but when it comes to finances, when it comes to valuations, I like to be very organized. I like to be very on top of things, because if you miss one thing, that's it. You'll get to this, and this is the nightmare. Get to this. If you get to this, you know that you did something wrong, and then you're gonna have a hard time just going back and fixing stuff, because everything is interconnected. All of the sheets basically down here, if you see, all of them are connected one to another. So basically, if we take a look at this one, so if you take a look at this one over here, this one is coming from the sheet of revenue and EBITDA forecast. So if you mess up one thing, you're done. So just be on top of things when you do the valuations. Working capital, man, sometimes I just don't. I'm telling you, I'm not that. Okay, I'll just go through it later on. I will continue doing the whole valuation later. I'm not gonna, I'll do it and I'll release it for my Substack subscribers, and I'll also update on my Instagram. By the way, let's see if anyone is watching. I don't know. I didn't check. No one's watching, but it's fine. Doesn't matter. I bought a new book. Let me unbox it. So the book that I bought is by Monish Babrai. If you didn't hear about Monish, you should start listening to Monish Babrai's interviews and to his lectures that he makes. He's one of the smartest investors out there, by the way. He's very good. And I wanted to buy this book for a long time now. It's the Dhandho Investor. I don't know if I can say it. Dhandho Investor, the Dhandho Investor. Yep, here it is. It's a very short book too. It's only 200 pages. It's not a long book. If you read 20 pages a day, you'll just finish it in like 10 days. It's nothing. I'll finish it in 2-3 days. See the topics. I know that he talks about the Patels in India, their model, like when they started like investing in motels and how they made a lot of money. So these are the, if you can see good over here. The chapters. I mean, I didn't read it, but I highly recommend it because I know I watched like a lot of videos from Manish, and I know what he preaches and what is his, let's say, framework when it comes to investing. See, like a few bets, big bets, infrequent bets. He has very concentrated portfolio, by the way. I think he has only Micron Technology right now. Let's see. He has Micron Technology and another stock. Let's just go check. Babrai portfolio. Yeah, it doesn't have a lot of companies. He's concentrated in few, and this is his style, I mean. Yep, yes, right now he's holding only Micron. He's holding only Micron. Yep, Micron. Yes. Yep, yep, yep. I mean, I'm not saying that this is a good thing to hold only one company, but if you're Mohnish Pabrai and if you're Charlie Munger and if you're Warren Buffett, you know what you're doing, and then it's fine to hold only one or two companies in your portfolio. But when you're getting started, of course, it's not investment advice. You can do whatever you want, but I think you shouldn't go all in on one stock unless you know for sure and you're like so, you know, sure that the company is gonna do well in the future, and then it's a different story. But no. What's this? Okay. This is a good website too, by the way. This is a good website too. This is MarketBeat. You can get 10 years worth of financial information about a company. You can download it directly to your computer, which is good, an Excel sheet. And this is what I do basically when I want to look for the like historical information of a company. And again, my computer is slow, so I'm sorry if it takes a long time to reload and everything, but so yeah, here we go. See, you can get 10 years worth of financial information of every company that you want, and then you can look in terms of percentages, meaning that you can take a look at the gross profits. You can take a look at, so they start with 100%, meaning that like for $1 of what you sold, how much money, how much dollars you spent on producing it, and then your gross profit, which is 100 minus 41.94, and then you have the SG&A, which is selling, general and administrative expenses, and then total operating expenses and operating income. So it's a good website, and then you can change again to what I told you. And if you click on the CSV, you can get to the Excel. I will show you what I mean. So you can get to this one. Wait. Let me just open it. Yep. You can get to this one. And you can do whatever you want with it, you know? Yeah. Let's take like only. Yeah. You can get to all of these in like literally one click. Okay, so I'm just gonna finish the stream for today with this. I hope I added value for you guys. I hope I showed you new things that you didn't know before. I'm gonna read this book. Probably gonna finish it, I don't know, soon enough. And maybe the next live stream I will talk about it and we will cover some interesting topics over here. And I will finish also the valuation of Levi, and I will post it on my Substack in case you want to go and subscribe over there. You can do it for free, by the way. You don't have to pay anything. And follow me on Instagram. Over there I post daily. I have daily updates. I give commentary on things that happen in the market today. Go check it out. I will leave a link in my comments over here. I mean, of course I'm gonna say it's good because it's mine, but it's really good. You should go check it. I think I provide a lot of value over there. So have a good day, and we'll see you soon.